Good morning, this is Dave Toth with an RJO MRT Technical Webcast update for Tuesday, November 9th. Because there seems to be an absolute feeding frenzy going on across a number of the commodity sectors, we're going to break from our typical technical webcast where we go into detail on one or two commodity markets and rather span across a number of the commodity sectors, a number of markets with more brief summaries of each individual technical condition across the energies, metals, live cattle, and the coffee, sugar, and cocoa markets. Starting off here with a daily chart of the front month crude oil, the December crude oil market. You can see the break above the May 3rd high of 87.15 that perpetuates or reinstates the broader bull trend shown here on a weekly log scale chart going all the way back to the February 09th low at 33.55 with indeterminate upside potential remaining above this market given the reaffirmation of the long-term bull trend. Perhaps most importantly, as a result of overnight's gains above last Friday's and Monday's highs, the market has defined the 85.96 corrective low from Friday and yesterday as the latest and tightest corrective low. The market is now required to fail below to even defer the broader bull trend, let alone threaten it. So shorter-term traders with tighter risk profiles are advised to trail protective sell stops to levels just below 85.96. But from a longer-term perspective, the market really needs to break below the 79.84 low from late October to expose a larger degree correction or reversal lower. Moving quickly to the RBOB market, you can see the market's assault on this pivotal 219 to 220 area we've been talking about for weeks, and by virtue of overnight strength to retest Monday's 219.38 high, we believe the market has defined yesterday's 215.28 low as a short-term but objective corrective low and risk parameter that shorter-term traders with tighter risk profiles should or are advised to have protective sell stops just below in the maintenance of a larger degree bull move and bullish exposure and bullish policy to a break above this key 219 to 220 area that could expose accelerated gains thereafter and possibly cite that May 3rd high at 244.11. Also looking at the heating oil market, you can see the continuation of the broader bull trend that defines Friday's 236.16 low as now the latest and tightest corrective low and risk parameter for a continued bullish policy. On a daily chart here, you can see the clear and impulsive breakout above that May 3rd high at 235.74 that maintains the longer-term bull trend that dates back to the March 09 low at 113.11. You can see virtually no levels of any technical merit whatsoever above current prices between spot and that July of 08 high way up at 415. So the upside potential here remains indeterminate and could be extreme, with weakness below at least 236.16 required to defer or threaten that continued bullish policy. Moving to the metals market, and not surprisingly, the gold market continues in its secular bull trend to new all-time highs. Overnight, it's up another $15 to an all-time high of $14.22. As a result, on an intraday basis of this continuation of this bull trend, we believe weakness below Friday's corrective low at 1371 spot 90 is required, and perhaps even in a even shorter term perspective, the 1386.60 corrective low from yesterday. But given the secular nature of this broader bull trend, we don't want to get too tight with trailed stops and expose ourselves to being whipsawed out of a bull trend that's one of the greatest in history, frankly. So continued bullish policy remains advised, with weakness below 1371.90 required to defer or threaten this bull trend. The silver market likewise continues its explosive price action with former resistance, new support around the $25 the figure area, the level the market needs to fail below minimally to defer or threaten the long-term bull trend. From a very short-term perspective, we can see by virtue of yesterday's and overnight's continuation of the secular bull, yesterday's 26.551.5 corrective low is the latest and tightest corrective low to which shorter-term traders with tighter risk profiles are advised to trail protective sell stops. In the December mini silver contract, we've been long since the 24.14 level, and by virtue of overnight's gains, traders are advised to trail protective sell stops to 26.51 on those longs from 24.14. And generally, a bullish policy, of course, remains advised as on a weekly log scale chart, you can see the explosiveness of the secular bull trend. There's virtually no objective technical reasons whatsoever to suggest that this market is doing anything but continuing in its secular bull trend to further and possibly still significant significantly higher levels from where we're currently trading. Again, with weakness below corrective lows like 26.51.5 or 24.75 required to defer or threaten the broader bull trend. Moving to the copper market, and as with the other metals, the secular bull trend remains intact here with today's reaffirmation of that trend to new highs, defining former 390 area resistance from October 27th as new support, and a failure below the 384.95 level required to jeopardize the impulsive integrity of this latest phase of the bull trend, required to defer, threaten the broader advance. From a very short-term perspective, and by virtue of overnight's gains, you can see yesterday's 392 low as the latest and tightest corrective low, to which protective sell stops should be trailed for shorter-term traders with tighter risk profiles. Moving to the cattle market. We've discussed this in our recent technical blog, but we think the 98.65 corrective high from last Tuesday, November 2nd, is a short-term but pivotal level that, if the market can recover above, will confirm a bullish divergence in momentum. And given such a divergence from, looking here at a daily chart, the lower extremes of the past couple of months' range and the area of the 50% retrace of the entire June through September rally from 90.77 to 102.60, we think that if the market can recover above 98.65 to define Friday's 97.10 low as a more sound low, and the end of this latest wave sequence down from that 102.30 could have a terrific risk-reward buying opportunity for at least a return to the upper end of this trading range, and quite possibly a resumption of the broader bull trend over the past year and a half to new highs above 102.60. This looks to be a particularly acute and favorable risk-reward trading opportunity above 98.65 with a tight 97.10 protective sell stop, and we'll go into more detail on a separate technical blog over the next day or two on that trading opportunity from the long side. We've been cautiously bearish this market since the market failed below the 99.60 to 100 area about a week and a half ago, but by virtue of this developing threat of a bullish divergence in momentum, we advise traders to move back to at least a neutral sideline position if the market recovers above 98.65, and then on subsequent proof of corrective behavior on setbacks, we think that'll reinforce or satisfy our three basing and reversal requirements for not only a reversal of the past few weeks sell-off, but quite possibly a resumption of the past year and a half's bull trend and new highs above 102.30. Moving to the coffee market, you can see here, the continuation of the secular bull trend with overnight strength, defining a recent corrective low at 203.30 from Friday as the latest and tightest corrective low and area of former resistance, new support. This market is now minimally required to fail below to even defer the secular bull trend, let alone threaten it. From a longer-term perspective, of a scale sufficient to expose a larger degree of reversal lower, you can see the past few days resurrection of the broader bull trend that defines the 192.80 corrective low from November 3rd, as we believe this market's most important technical level, as that'll be if the market fails below that level, that'll confirm a bearish divergence in momentum of a scale sufficient to really jeopardize the longer-term bull trend, especially given the insane levels of bullish sentiment according to this market. In sum, a bullish policy and exposure remain advised in this market as well, with weakness below at least 203.30 and preferably 192.80 required to defer or threaten that bullish policy and bullish positions. The sugar market, as well as continues its major move higher, clearly with another round of gains overnight, and looking at a short-term intraday chart shown here, by virtue of the past few hours, continuation of the secular bull, the market has defined the 30.68 corrective low from Friday, an area of former resistance to support, as the latest and tightest corrective low and tightest risk parameter the market's now required to fail below to even defer the bull trend in favor of an interim corrective setback, let alone expose a reversal. So a full bullish policy remains advised in the sugar market as well, with weakness below at least 30.68 and preferably the 27.41 corrective low from late October to defer or threaten the broader bullish count. And lastly, and perhaps most importantly, we've had a sharp recovery in the cocoa market. We discussed this in a recent technical blog. By virtue of the market's failure to sustain new lows below the 27.56 area, former support, new resistance, and especially last week's corrective high at 28.20, the market has defined yesterday's 26.96 low as the end to this recent sell-off from October 27th's 29.49 high. And the reason that could have important long-term implications, shown here on a daily log scale close only basis, this recent setback stalled within a few points of the 27.28, 61.8% retrace of the September through late October rally from 26.10 to 29.30. And if the market can maintain its impulsive integrity from to the upside from this point onward, we believe that the market is within the context of a much broader basing and reversal environment that could have massive implications in the weeks, months, and perhaps even quarters ahead. Moving here to a weekly log scale chart, you can see this entire year's sell-off from the December 16th of 09 high of 35.10 to the recent 25.95 low. Thus far, this week sequence is only a three-wave pattern down, left unaltered by new lows below 25.95. It's quite arguable that this year's entire setback is a long-term bull market correction, resuming the long-term bull from the October 08 low at 1867. The implications of this is that eventual new highs above that December of 09 high of 35.10 lie in the months ahead. Looking here at the both measures of market sentiment that we watch, especially the MRT bullish sentiment index of large spec bullish exposure, the recent 41% reading is the lowest this market has had since the October 06 period that accompanied a major move higher. By virtue of this short-term gains yesterday and overnight, we believe that the odds have now tilted back in favor of this much broader basing and reversal threat that exposes significant gains above that late October high at 29.49 on an intraday basis and the 29.30 high on a weekly close only basis. Looking here at an intraday chart, if a broader bullish count is unfolding, you can see the impulsiveness, the trendiness of yesterday's and overnight's gains. The third requirement, basing and reversal requirement that we abide by is proof of three-wave corrective behavior on a subsequent setback attempt. If the market provides that kind of price action, and we strongly suspect it will in the days ahead, a corrective bull flag setback type of pattern reinforcing this broader basing and reversal threat, we will look to advise a bullish policy and exposure for what could be a significant gains in the weeks and months ahead. For the time being, by virtue of the short-term gain above 28.20, traders are advised to move to a neutral sideline position and just await the proof of that corrective behavior back that will, we believe, reinforce that broader bullish possibility. Thank you for bearing with us in this longer technical webcast today, but we think a number of issues are pertinent across the entire commodity sector, and that's not even discussing the huge crop reports coming out today that are very likely to have some significant effects in the corn, wheat, and bean markets as well, and we'll touch on those later in today. Please stay tuned to updates on these and other markets on our RJO MRT website, MRT.com website, and good luck with today's training.